Emerging markets surprised investors last year, outperforming US stocks by 16 percentage points. It was one of the strongest showings in over a decade. But before calling it a turning point, there's a catch. Much of that performance depends on global conditions, especially the US dollar.
One of the tightest correlations that we see in markets is the inverse relationship between the dollar and emerging market versus developed market performance. So it's an inverse relationship, so that when the dollar outperforms, emerging markets have always underperformed, and vice versa.
In fact, many of the currencies in these emerging markets are on a long-term weakening trend against the US dollar.
And that relationship can turn quickly, because the same forces that move the dollar, like inflation, interest rates, or global shocks, can shift the outlook for emerging markets. The conflict involving Iran is one example. It has pushed oil prices higher, raising inflation risks and potentially delaying interest rate cuts.
Oil price can go from 80 to 120 and back to 80 in a week, but can it stay above 100 for a sustainable period of time? And then it will spike inflation up across the board. That can change the trajectory of central bank policies, right? Probably delay some of the rate cuts that we are anticipating in the markets.
That could strengthen the dollar and shift money back into safer markets like the US.
Historically, EM outperformance tends to be cyclical. We generally have 1 year of outperformance, followed by 2 to 4 or 5 years of underperformance in the EM. I looked back at data from 2010, so about 16 years of data, annual returns. You see outperformance in 2010, followed by outperformance in 2012, and then only in 2017, and then 2025. So out of 16 years, we've actually had 4 years of outperformance in the EM compared to 12 years of outperformance in the S&P 500.
For more than a decade, the United States has dominated global markets, driven by big technology companies. Emerging markets, countries like China, India, Brazil, and Indonesia, struggled to keep up. Now, that gap is narrowing. The question is, does it last?
We tend to believe that there are very long cycles at play, and that rather than necessarily just being a short blip in a long-term downtrend, this could be the start of sustainable outperformance.
So why are investors talking about emerging markets again? One reason is price. Emerging market stocks are trading at a discount compared to developed markets.
Currently, despite the fact that the emerging markets have actually outperformed in 2025 and year to date, they're still trading at a 30% discount on a forward PE basis and a 40% discount on a price to book basis. What causes that apparent valuation discrepancy typically revolves around what is the quality of earnings, what is the ROE of companies, and what is the earnings growth. Now, for the last 15 years, emerging market earnings growth has lagged developed market earnings growth. More because on a earnings per share basis than earnings. But if you're going forward, you're going to get a very similar level of earnings per share growth out of emerging markets and developed markets. That should lead emerging markets to re-rate towards developed markets.
In simple terms, emerging market companies did grow profits, but issuing more shares diluted returns. If that changes, prices could catch up. Cedric disagrees.
From my experience, a prolonged discount gap usually isn't a for sale sign. It tends to be more a beware of the dog sign. So I don't believe that there's a compelling reason for the discount gap to continue narrowing. There are structural reasons for the gap, such as higher earnings growth in the United States, better corporate governance, lower perceived political stability in the United States.
In other words, cheap doesn't always mean opportunity. Sometimes it reflects deeper structural issues. And emerging markets are not a single story.
The emerging market space really comprises of many distinct countries with their own market dynamics, their own political landscape, their own governance issues.
China, for example, has been a major drag in recent years, even as other parts of emerging markets held up better.
China was down 40% over that period. The rest of EM ex-China was up 28%.
Even within markets, sectors are moving differently. Investor money has flowed heavily into technology, leaving other sectors looking relatively cheaper.
Consumer stocks in emerging markets are looking cheaper than they ever have relative to the rest of the market. Why? Because all that attention and all the money has been focused and sucked into the AI stocks.
There is also a simple reality. When global markets fall sharply, emerging markets rarely stand apart.
When the US market has a down day, the emerging markets tend to have a down day the next day as well.
So, is this a turning point? For now, the evidence is mixed. Emerging markets are showing signs of life, but the structural challenges remain. The opportunity is there. The risks are too. So for most investors, this isn't about making a big switch.
My recommendation is that for most investors, there's probably a space for both US market and emerging market. Based on historical performance over a long period of time, meaning the past 20 to 25 years, I would say that investors probably would like to have a larger allocation to a developed market like the US and a smaller allocation to emerging markets. Stick with that allocation for a longer term period, say 3 to 5 years, and I believe that investors will end up with good outcomes.
It's more a diversification argument. Even in a normal event, I'd rather have some exposure to as many different asset classes as possible.
You don't have to bet on a new era for emerging markets, but you may not want to ignore them either.